We've got three indicators that predict recessions 100% of the time, confirming one is right around the corner here in the United States. How have stocks performed in the previous three recessions that we've seen? And we'll discuss some strategies on today's show. What is going on, investors? Hopefully, guys are doing well out there. Let's talk about the recession word. And for some of you that may have only lived through one of these, especially the last one, which was so short-lived that many of us don't even remember it. But a recession is, by definition, a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in two successive quarters. So basically what this means is a contraction in economic activities, and the indicator is actually a lagging indicator. You get a fall in GDP by two successive quarters. That basically means you're in the third quarter of the recession before you actually confirm it. So this is why we tend to look at forward-looking indicators to determine if we're about to be in recession, then rely on the backward-looking GDP, which confirms it. Now, U.S. recession risks rise as the Ukraine and Russia add to inflation, and some strategists say that a recession is right around the corner. S&P 500's decline in recent weeks suggests a 40% likelihood of a United States recession, which would lead to lower valuations and earnings, according to Goldman Sachs. Separately, the firm's economists estimate a 20 to 35% chance of a U.S. downturn over the next year, roughly in line with models based on U.S. Treasury yields, which we'll talk about here in a second. There's already signs of a slowing occurring. This is according to Morgan Stanley's cycle indicator, which aggregates key cyclical data to get a sense of where the economy is within its cycle and where the headwinds and tailwinds exist. Its model is currently in the expansion phase with data above trend and rising, indicating that the economy is into a mid to late cycle. At its current pace, the indicator could peak in 2 to 4 months and move to downturn, otherwise known as a recession, in 5 to 10 months, according to Morgan Stanley. Now, JP Morgan disagrees. They aren't seeing a large risk to a recession. In a March 17 note, JP Morgan noted that equity sectors, including innovation, tech, and biotech, and emerging markets, are already pricing in severe global recession, which will not materialize in JP Morgan's view. Still, they don't rule out the possibility of a recession in Europe and further slowdowns here in the United States, as they note many stocks are down 60 to 80% in some of those sectors. Now, let's jump into the three indicators, since we talked about how with recessions, we like to look at leading indicators that lead us into recession. This is a chart of the Consumer Price Index, otherwise known as the CPI. This is based on a percentage change from a year ago. So as these lines go up, you have inflation going up on a percentage basis. As they are going down on a year-over-year percentage basis, Consumer Price Index is actually going down. And as we've noted here on the channel, anytime you've got above 5% on this left-hand column, you get above 5% on this CPI, it basically predicts a recession 100% of the time. You see, back in 1948, you had a reading over 8.8, only to be almost immediately followed by a recession in 1949. Notice just a couple of years later, the CPI again peaked out at 9, only to have a recession, not necessarily as close as we've seen here on the other portions of the graph, but a couple of years later, you did have a recession. You have other areas where CPI peaks, not quite over 5. It also predicts a recession almost all of the time. Here's another reading above 5%. That was back in 1970, and you had a recession following immediately after. Again, in the 1970s, you had reads well above 5. It predicted a recession as well. Again in 1980, again in 1990, and again in 2008. And currently, now the CPI reading is well north of 6%. We'll see when a recession follows. Notice that I said when and not if. Now, what is driving the vast majority of the CPI reads that is accelerating? Well, most of it has to do with energy prices. We see crude oil prices here. We don't get as big of a data set as we do on the CPI index, but we see that whenever crude oil tends to spike, recessions end up following. We saw that in the 1990s. We also saw it in the late 2000s. We saw it again during the great financial crisis back in 2008, and we are likely going to see it again here in the next 12 to 24 months. Now, those are the obvious indicators, but one indicator that is starting to show that a recession is very much about to come here in the United States is the 10-year Treasury maturity minus the 2-year Treasury. So hear me out here for a second. So essentially you have bonds issued by the United States government in different years of maturity. So you have 2 years, you have 10 years, you have 30 years, all along the curve. And typically what happens is when you loan people a shorter period of duration, so let's say 2 years, well, the interest rate on that tends to be lower than if you were a loan person, or in this case, the government, for a longer period of time, say for like 30 years. And so what this graph represents is the spread between the 10-year interest rate and the 2-year interest rate. And off the top of your head, you should say, well, the 10-year interest rate should always be a little bit higher, because if you're going to loan somebody money for 10 years, you would want a much higher interest rate, because you're going to be parting with your money for a much longer period of time than if somebody just wanted to borrow money from you for 2 years. If somebody wanted to borrow money for you 2 years, well, the interest rate would probably be lower than if they wanted it for 10 years. But an interesting thing happens, especially before we have a recession, is the yield curve starts to flatten, and in some cases actually inverts, where you actually have 2-year government debt yielding higher interest rates than actually the 10-year interest rate. And it has happened several times over the last several decades, and every single time the yield curve inverts, or in this case, the 2-year Treasury yields more than the 10-year Treasury, where every single time it has predicted a recession here in the United States. You see it did here in the 1980s 2 times. You also saw it in the late 90s. You also saw it in the late 80s as well, triggered a recession. You also saw it again in the 2000s. You also saw it again right before the great financial crisis as well. This typically precedes a recession by several months, and you might be wondering, well, where are spreads right now? Well, before the recession we had in 2020, we saw yields invert just very temporarily, and we are seeing the same type of trend happen in February and March of 2022. We're looking for yields to eventually invert. Now, we see it here on the chart as well. I've charted 10-year in the candlesticks. Basically, it looks like Christmas because it's red and green. And the 2-year is in orange whenever these lines start to meet. And I've highlighted it here in red where they actually crossed. That lines up with the recessions that we saw follow once those yields invert. And we see here on the most recent data that we have is that these lines are about to cross once again. And if they do, that certainly can be an indicator of a recession, especially the longer that they invert. It's almost 100% of the time that we end up with an economic recession. Now, some of you might be wondering, well, we're headed into a recession. How should I allocate my portfolio? What should I be doing? And I will tell you a couple different things that you can think about, okay? Equities tend to peak and have pretty sizable rallies heading into recessions. This is the last one that we had, last serious one that we had back in 2008. You see here on the Dow Jones Industrial Average here on the top, the index topped out over 14,000 only to bottom out about a year later at about 6,500. Yeah, that's a massive drop. And then a couple of years later, it gained about 50% of its value that it happened to lose. 10-year treasuries, or otherwise known as interest rates, those almost all the time. In fact, they tank. And so part of the complication with this recession could be that the Federal Reserve doesn't raise interest rates fast enough, and there's not a lot of room for those treasury rates to go down. Some people would argue maybe they're getting out in front of that right now. The other thing that tends to spike during this period of time is the Volatility Index, otherwise known as the VIX. It's a fantastic time to do some trading, do some options trading. If that happens to be a thing, you see wild swings. You see big up and down days when you are in a recession. But But broader term, kind of cycling things back, looking backwards, recessions are almost always, in fact, they're always great times to actually accumulate equities if you have a long-term focus. Here's the last recession that we had back in 2001. We see a similar type price action. The Dow Jones was up over 10,000. It bottomed during the recessions close to about 8,400. A few years later, it bottomed down at about 7,200, only to get back to about 10,000, or essentially the pre-recession highs several years later. You notice that 10-year Treasury notes, interest rates tend to decline, and also the volatility index tends to have big spikes and swings during that time as well. The last recession that we'll look at is the 1990 recession. You see the Dow Jones Industrial Average was up over 3,000, only to bottom closer to 2,300, and then rallied just a few years later up and over the highs that it had made before the recession. You also see Treasury yields decline, and you see volatility spike as well. Recessions are opportunities. Don't let them make you fearful. If you were close to retirement or you were in retirement, you want to tread water a little bit more carefully, because you might not have that time frame after these recessions are over to really recoup a lot of the losses that you might experience during this downturn. If you're my age, which is like 40 years old, maybe even up into your mid 40s and younger, these are times you should be very excited about. These are areas where you can accumulate stocks, but it also can be a time where you actually develop some new strategies and play the volatility that I showed you that enters the markets whenever you have a recessionary environment. These pops and drops can not only be very profitable, but also a very exciting way to enhance your trading strategy and your investing strategy as well. Don't pigeonhole yourself into a buy and hold investor or a certain type of investor. During recessionary times, you can change up the playbook and certainly profit even as stocks and the market and the economy head downward. That was today's video. Hopefully you guys enjoyed it. We'll be back again soon with more. Good luck with your investments.